So let's crack on this morning. So just as you expect, the kind of things we're going to be talking about today, basic extractions, by which I mean what you probably talk about with most of your accountants, sort of dividend, salaries, etc., that sort of thing. We'll touch on pensions, a few other ideas for extracting value, and then some sort of recent updates on HMRC, so a take on these things as well. So before we sort of delve into the numbers, I think there's just a couple of things that we like to sort of reiterate and emphasize that are not necessarily strictly to do with the numbers. So we often look at sort of salary versus dividend in terms of way to remunerate ourselves, but I think there's often a point missed as to a dividend is not designed to reward the work you do on a day-to-day basis. You pay a dividend as a return of your investment in the business. It's sometimes quite hard to see the distinction in an O&B business between being a shareholder and being a director and running the business. But there is a technical difference. There is a difference between what you're taking out as salary and what you're taking out as a dividend. So we'll come on to that a bit more detail as to what the differences really are. But it's worth trying to remember you're wearing two different hats when you're in a managed business, one as a director, one as a shareholder. Other things you need to think about is actually, rather than what you're taking out, is also what you're leaving in. So you do need obviously money to run the business. You need sort of some working capital. You need some money to left behind. So you will need to think about what's actually going to remain in the business. That's as true for even, if you're a one-person company offering services and you might think you could just take out all the money, but there's always going to be costs coming up that you need to budget for, etc. So it's worthwhile thinking about what money you need to leave behind in the company. And then one other point I'd just like to flag for people earning certain amounts. So childcare accounts. So if you have children in either nursery or education up to about 11 years old, you can qualify for childcare accounts, which is a bit like an ISA in that you can put up to £4,000 a year in there, and the government will top it up by another £1,000. So the point to do with that is that it's a cliff edge, those accounts. If you earn more than 100,000, you will not qualify for those accounts. So if you earn £99,999, you can qualify. You earn 100,000, you don't qualify. So that extra pound in income can cost you £1,000 in your childcare account. So when you're looking at overall strategies, if you do have a childcare account, it's worth bearing that in mind. So let's move on to the detail then. So first of all, we're going to look at salary. So salary, as we said before, is a reward for work. It's what you're doing on a day-to-day basis. Obviously, the biggest question is how much. As we said, there's many considerations there. It's as much about what you leave in the business as what you're going to take out. And also having an eye for the future, which we'll come on to as well, if you've got a potential exit on the horizon. In terms of the amounts you can get for a corporation tax deduction, the test you have to meet is that you've paid the salary wholly and exclusively for the purposes of the business. Now, that's obviously quite a vague definition and doesn't really give you a steer on quantum. HMRC do say that if you are a controlling director, that's basically a director who's also a controlling shareholder, then they are unlikely to really challenge the amounts. Salary, as it is for pension, they look at your overall remuneration package and say, is it paid wholly exclusively for the purposes of the business? The reality is I've very rarely seen that challenged. I can only think of one example where I have seen it challenged, and the amounts paid were rather high, so therefore were flagged to HMRC as but if you're sort of paying yourselves tens of thousands, hundreds of thousands, you'll probably be all right in terms of getting the deduction in terms of quantum. Another thing to be aware about is the employment allowance. So the employment allowance is a relief against employers' national insurance. employer's national insurance is charged at 15% on your salary above £5,000. So if you are paying yourself a salary, you will be paying employer's national insurance. The allowance essentially is just a straight deduction from the employer's NI liability. And one of the reasons to flag it is that if you are a single director being paid by the company, you do not qualify. So if you're just on your own being paid as a director, you do not qualify for this allowance. However, if there's two or more of you being paid, you will qualify for this allowance. Now, you have to be paid at least £5,000 each to qualify. But if you've got spouses or something that you own the company, then as long as you're both being paid from the company, then you should qualify for that allowance. And then just in terms of the admin, you've got the RTI returns, so that's real-time information returns that you have to submit to tell HMRC about the payroll about the salary you've just taken. So that's required normally on a monthly basis. On rare occasions, they'll allow you to do annually if you just want to take a lump sum, but typically they will want a monthly return filed. Even if you just take the money out in, say, March each year, then they'll still want a nil return for the rest of the year. So it's worth being aware of your filing obligations. Unlike in the olden days, where if you were below certain thresholds, you could just take money out and not tell HMRC. Under real-time information, regardless of the amounts you take, you have to file RTI returns and will be penalised if you don't. Now, with salaries, typically the actual salary itself can be sort of phrased that there's fairly rigid in amounts, in that you typically take a similar amount each year. You could obviously, when we talk about salary versus dividends, we are typically talking really about bonuses versus dividends as opposed to the regular salary. It's in all cases really going to be beneficial to pay at least some salary, because you're going to want the state pension credit. So at the moment, to get the state pension credit, you have to pay at least £6,500. The earnings limit for employers' national insurance is £5,000. So to get the state pension credit, your employing company will be paying national insurance. A personal liability to national insurance doesn't kick in until you start paying over the personal allowance. That's £12,500 basically. So it is possible to get a state pension credit without personally paying any national insurance, but the company will pay some. The amount you'll pay in national insurance will be offset by the fact the salary will be deductible for corporation tax. You'll save more in corporation tax at either 19 or 25%. Then you will pay a national insurance of 15%. So even though you have a liability, it's still worthwhile doing from a company perspective as well. Now, each time you take a salary, the tax and national insurance you have to deduct from that is then payable over the following month. So because we have this silly tax year in the UK where we go from 6th of April to 5th of April, every salary month is then based on the 6th to the 5th. So you have the first salary month from the 6th of April to the 5th of May, and then the 6th of May to the 5th of June, and so on. And it's that period you then have to report basically within 14 days of the end of that period. And then you have 3 extra days to then pay over the tax. So that's all the admin of salaries. We'll have a look at dividends. So with dividends, you do require positive reserves. That essentially means you've been profitable over the lifetime of the business. So a dividend is an extraction of profit. So if you're not profitable, you can't take a dividend, and your sole way to remunerate yourself will either be salary or pension or some of the other small things we'll come on to. So you need to prove you have reserves. But at what point do you need to prove that? So there's technically 2 different types of dividend. There's interim dividends, which you'll pay during the accounting period. And then there's normally one-off final dividends that relate to the prior period. So for interim dividends, you really need to be able to show that you have those reserves at the point you're paying that dividend. Directors make decisions about interim dividends, and it's the directors' board minute that would be required to then issue that dividend. For a final dividend, you're looking at the final set of accounts. So if you have let's say you have a December year end. So if your December year end is December 25, you could issue a final dividend now based on the 31st December 2025 accounts showing reserves. If you're looking to pay a dividend based on the 2026 figures, you'd have to prepare management accounts. That may be the case, for example, that you might not have had reserves at December 25, but in the last 3 months, you've had a really good year and you believe you've now got reserves. You would produce management accounts to show that you can actually take a dividend at this point and that you're not relying on the accounts to December 25, for example. So as I said, there is you have to produce dividend vouchers and minutes and board resolutions if you're doing a final dividend. So you do need to do the proper paperwork to demonstrate a dividend has actually been paid. Another option around shareholdings is to use different classes of share. So the answer for one person might not be the same for the other. So again, you maybe have an example where you've got spouses owning the shares in a business. One of those spouses may have maybe a job elsewhere, and therefore they're already using up their allowances and basic rate bands, etc., from their salary somewhere else. And then perhaps you have one spouse who doesn't have other income and therefore wants to use their basic rate bands and dividend allowances and things. So having different share classes permits you to issue different levels of dividends to each spouse. Now, HMRC have historically not particularly liked dividends being paid in differing amounts to different spouses. They did try to take a case of this, gosh, how long ago was that now? Probably nearly 20 years ago now. Jones and Garnett case, referred to as Arctic Systems. There we had husband and wife owning a company. It was said that the husband did produce most of the value. He was actually an IT contractor and provided the services of the company personally. But any dividends paid was split with him and his wife and was skewed towards his wife to use up her allowances and things. HMRC tried to challenge that and said, actually, these dividends should be taxable on him because he's the one creating the value, and that the different share class was in fact just a right to income, which under what we call the settlements legislation could mean that the income is then taxable back on him. Now, they did actually lose that case. It broadly came down to the fact that shareholding is not just a right to income, it's also a right to capital, and often it's got other rights as well, voting rights, etc. So it's important that if you have different share classes, you're looking to pay different levels of dividend, that you don't just have a right to income, you have other rights as well. Otherwise, in theory, the settlement legislation could change who's actually taxable on that dividend. A similar way to achieve that is what we call a dividend waiver. So a dividend waiver is effectively saying, I don't want to take my dividend. So if you didn't have different share classes, but you did have the same sort of situation where you had one spouse who would benefit to take the dividend and one where they would pay more tax, for example, then the person who would pay more tax could waive their dividend, say, no, thank you, I don't want it, just pay it all to the lower earning spouse. In that particular example, again, you're really shifting income, and it's more likely that the settlements legislation would apply. If it was a one-off, it's highly unlikely that would be attacked, if you like, or challenged by HMRC. But if it's a regular occurrence, I can see HMRC taking an interest in that and saying, haven't you really just made a gift of income to somebody else? You also need to be clear that if you do waive a dividend, you still need reserves equal to the total dividend that would have been paid, even though you haven't actually taken it. Okay. So another thing to think about is what we said at the start is about what is a dividend compared to what is salary. I said salary is in relation to your duties. A dividend is in relation to your investment in the business, your shareholding. If you try to pay yourself and remunerate yourself as dividends, there can be situations where that is reclassified as salary in certain circumstances. So this most famously happened in the PA Holdings case. In that particular case, People, instead of receiving bonuses, were given shares in a company and then issued dividends, because dividends are taxed at lower rates than bonuses. Now, that was a rather contrived setup, but the point was they were replacing bonuses with dividends. If you ever set up a situation where you were taking a certain level of salary and then replace it with dividends, that could potentially be attacked. So if you've always taken small salary and taken the rest of dividends, that would be fine. What I'm saying is, if you have changed your policy and decided to take lower salaries and then want to roll that back and say, actually, no, I want to go back to small salary and pay dividends, that could potentially be challenged because you're replacing salary with dividends. So it's just to be careful about what you decide now to do in relation to salary v dividends, making sure you don't basically shoot yourself in the foot if things change in the future. You could, in theory, I suppose, make sure any salary is discretionary. So as in it's more bonus than regular. If you did that, you're more defensible position. But if you increase and take a high monthly salary, it's very difficult to replace that in the future with a dividend. Now, in terms of sort of the cash flow on the tax, with dividends, you're going to declare that on your self-assessment tax return. So you'll be paying the tax on that in January and July each year. With salaries, obviously, the tax is deducted monthly, as we said. So from a cash flow perspective, dividends also have that advantage over salaries as well, that you have the money in your pocket longer before you have to pay over the tax. Now, the reason the sort of question of salary v dividends has risen its head again is really because from April, so next week, in fact, the tax bands have just increased by 2%. So from the 6th of April, the basic rate of dividend tax and the higher rate of dividend tax have both increased by 2%. Interestingly, they didn't increase the additional rate by 2%, so the very top rate of dividend tax has not increased. So, factoring all that in, rather than sort of bore you with the very detailed calculations, although we can share these if they're of interest, the conclusion really is that the status quo does prevail, that we would still normally recommend taking small salaries, especially to get the state pension credits. There is, as we said, employers' national insurance on that, but that amount, which I've calculated using 25-26 rates to be £225, is less than paying voluntary Class 3 national insurance if you haven't taken the salary and decide later on that you want the credit for it for that year. You can voluntarily pay national insurance and claim a credit for state pension. So even though you are paying some national insurance, it's still worth doing. So as a minimum, you're looking at 6.5 salary. It is, in fact, still worth going all the way up to 12,500. Whilst you're still paying national insurance. If you're getting corporation tax relief for that, because you're a profitable company, then you're going to be saving corporation tax at least 19%, if not 25%. So whilst you're paying 15% national insurance, there's still at least a 4% advantage, if not a 10% advantage, because you're getting corporation tax relief on both the salary and the national insurance cost. So generally what we recommend is still going for the 12.5 salary and taking anything over and above that as dividends. Now, for the higher earners amongst you, there does become a point where salary starts to become more efficient, and it's around sort of the 350,000 mark. It does depend on that's sort of based on just salary v dividends. If you've got other sources of income, if you're making charitable donations, if you're making pension contributions personally, those numbers are going to change. So you do need to think about this on an individual by individual basis. But broadly speaking, around that sort of level, salary actually starts to become more efficient, because at the very highest rates of tax, the marginal rate of tax, which is how much tax you'll pay on the next pound of income, is higher for dividends than it is for salary. But at the lower rates of tax, so your basic rate and your higher rate tax at the 40%, what would be the 40% band, you're actually paying your marginal rate is actually lower on dividends than it is on salary. So because you're paying less tax in the lower rates, but when you get to the higher rates, you're paying more tax on dividends. At some point, the lines cross over. So salary is less efficient to start with. Dividends, and at 350, they cross over, and salary starts to become more efficient. So if you're lucky enough to be able to earn that kind of money, then it's worth thinking about bonuses rather than dividends. Okay, so looking at other ways to remunerate yourself. So I think pensions is a fairly obvious one. If you're making personal pension contributions, you are limited to your earnings in the year. Dividends are not earnings for that purpose. So if you do go ahead with the small salary, big dividend route, your earnings would be considered 12,500, not 12,500 plus dividends. So the amount of tax relief you can get on pension contributions would be limited to your earnings. It's worth noting that whilst you do get tax relief for pension contributions, there's no relief for national insurance. So what that means is if you are paying yourself a salary, you're paying national insurance on that. You can get the tax relief back via your tax return or via your PAYE code, but you can't get relief from the national insurance. Contrast that with making company contributions, employer contributions. You are not limited to your earnings. A company can contribute more than you earn in a year. It is restricted to the amount of annual allowance you have available. You need to take some financial advice to work out what those annual allowances are. They start at 60,000, but get reduced if you're a higher earner. Because the company's making the contribution, no one's paid any national insurance on that contribution. So tax, you're also saving national insurance. The company should also get corporation tax relief. And as alluded to earlier, you do have to think about the sort of holding exclusively, how much am I paying in to this pension? Is it going to be deductible for corporation tax? Is this the amount I would normally pay a third party to get the same amount? Would I pay them as much as that? Now, that's sort of HMRC's taken in their guidance. In reality, I don't think I've ever seen that challenged in my, I don't know if I'm doing this 22-year career. I don't think I've ever seen that challenged at all. Now, I think we're going to talk about interest and rent. This is something that seems to be often overlooked. So if you have something of interest, if you've lent money to your company, you are perfectly entitled to charge your company interest on your loans that you've made. The interest, as long as I said it's up to a commercial rate, it can be lower, but as long as it's not higher, the company should get a corporation tax deduction for that. Now, you will pay tax on interest at 20%, 40%, 45%, depending on your level of income, but there's no national insurance, importantly. So unlike dividends, where you're paying the dividend out of already taxed income, i.e. it's already paid corporation tax before you pay it out, and unlike salaries where you have to pay the national insurance on top of your personal taxes, with interest, you can just pay personal tax. There is no corporation tax because you get a deduction for it, and therefore the marginal rates are 20, 40, and 45. If you look at dividends or salary, the maximums are around 54% when you factor in corporation tax, employers' national insurance, and personal taxes. So it suddenly looks very attractive to take interest on loans. Now, it's worth noting, though, that with interest, there are admin requirements. So the company is required to deduct 20% tax at source before it pays it across to you. It then has to report that quarterly to HMRC on what's called a Form CT61. So with all the admin involved, it's really only going to be worth it if there's a significant loan into the company. If you've just lent a couple of thousand, it's not going to be worth the headache of trying to get, just a few, maybe even 200, 10% interest on that kind of number isn't necessarily going to make it worth your while with all the admin involved. But if you've made a sizable loan to the company, it's worth thinking about whether you want to charge a commercial rate of interest. Similarly, with rent. So if you happen to own commercial premises that you own but the company uses, you can charge the company a commercial rent, or indeed if premises is inside a pension scheme, for example, you can also charge commercial rent. So it's the same sort of tax position as noted for interest, i.e. that you're paying 20, 40, 45%, but there's no withholding tax on that. So you just pay the tax via the self-assessment system. So rent and interest can be very efficient ways to extract money from companies. Indeed, they probably are the most efficient ways to get money out of a company. And obviously with properties, there are other considerations around inheritance tax and things like that you'd also want to factor in. But if you do happen to have a property outside of a company, then it is worth thinking about rent. So what else can we think about? So for many years, the tax system has been used to try and encourage ownership of electric cars. Now, from a personal tax perspective and the company's tax perspective, there are still some advantages of doing that. I appreciate there's changes to sort of road tax and things like that there's going to change for electric cars. But from a purely sort of looking at personal income tax liabilities and corporation tax liabilities, there's still a fairly efficient way to get money out of a company. So rather than, I've used an example here of buying an electric car for £100,000 just to make the numbers a bit easier to follow. So if you do buy, and it has to be a brand new electric car, I should emphasize for these numbers to be correct, as opposed to a second-hand one nowadays. So if you buy a brand new electric car, then there is a taxable benefit in kind on you personally. So that's effectively treated as additional salary. The company would also pay employers' national insurance on that benefit in kind at 15%. So that table there really is just showing you the personal liabilities and the company liabilities for owning that car and allowing you to use it. Now, if you sort of look at that sort of number of the personal liabilities, only around 11,000 for you to extract, and that's assuming the highest rate of tax as well, that you're a 45% taxpayer. If you were to extract £100,000 at 45% tax, clearly you're going to pay 45,000 in personal tax to do that, plus personal national insurance of 2% as well, so another £2,000 on top. So that's clearly an efficient way to get money out of the company using the rates that we know. So it's quite handy that they have announced the benefit in kind rates up until 2029-30. So those benefit in kinds is as announced by the government already. So we know what they look like. We don't know what the rates are going to look like after 2030 at this point. But it has been made clear that in the future, there's going to be fewer incentives via the tax system to buy an electric car. So if you are looking for more of a long-term ownership, it's just bearing in mind we don't know what the position will be post 2030. So it's not, I suppose, remuneration as such, but as we're sort of badging this up as ways to look at extraction from a company, then we should also mention loans. I think people run away from loans sometimes because of the taxes involved, but there could be potentially situations where it might be worth considering taking loans from a company. So if you take a loan from a company and you're not paying any interest on that, it creates a benefit in kind that, again, you would report via a P11D and pay tax for it by either your self-assessment or via a PAYE code on your salary. That's assuming the loan goes over 10,000 at some point. The 10,000 limit is really to stop season ticket loans being caught by this legislation. But any loan you take over 10,000 will have a benefit in kind on it. And it just has to go over 10,000 at some point in the year. So it doesn't have to remain above 10,000. It just has to have hit 10,000 at some point. The benefit in kind is effectively the interest you haven't paid. The interest rate they use is what's called HMRC's official rate of interest. It's not the Bank of England rate. HMRC set their own rate. And they have just announced it's going to remain at 3.75% going into 26-27 tax year. They do look at that interest rate quarterly, or in theory they do. They haven't changed it since the start of last tax year, of this tax year, 25-26. So if you took a loan out of the company, you would pay a small benefit in kind charge on taking the loan out personally. But that pales into, then that would be every year you had the loan as well. So from the start of when you had the loan until you repaid it. Now, if you do take loans from the company, you do have to watch out for something that's called Section 455 tax. I'm afraid we don't have a more catchy name for it. It is just named after the legislation that imposes this tax charge. And what it does is it charges the company, as opposed to you personally, a tax on that loan at the higher rate of dividend tax. So from April, that higher rate is going to be 35.75%. Now, that tax charge only kicks in if the loan isn't repaid within 9 months of the year end. So if you have a March year end, for example, you could take out your loan on the 1st of April 2026, and as long as it was repaid by the 31st of December 2027, this tax charge would not apply. So you could take the money out, and as long as you can get a better return than the 3.75% interest you're being charged on it by the government, then frankly you're able to earn some money in your own pocket above that, then there's potentially thoughts that could be worthwhile doing. As I say, you do have to repay the loan, otherwise the tax charge kicks in. But it's worth noting that the tax charge, as I said, is paid by the company and not you personally. The company can also get that tax back at some point if you do repay that loan. So, or it's written off, but that's not necessarily a good idea to do that. So if you repay the loan, you'll get the tax back. There is a bit of a cash flow issue because if you repay the loan, you only get the tax back 9 months after the end of the accounting period in which you repay it. So if you can avoid paying the tax, fine, it helps with the cash flow. But as I say, the company liability could in theory be interesting compared to having to pay that tax yourself personally, because you haven't had to extract the money to pay that tax. The company's effectively paying it on your behalf. So it would be worth thinking about in certain circumstances. So I did mention this earlier, but just going into a bit more detail. So if you are looking for a potential exit from the business, then you might want to think about, rather than maximizing your income at this stage, whether you start to leave some of the money behind and just take out what you need to live off. If you're looking to exit, so that might be a third-party sale, or indeed if you're, a sole trader, you might think, I'll just liquidate the company when I've finished doing and I want to retire. Then you can think about whether you leave money behind, create the value in the business, and potentially exit and pay capital gains tax rates. Because if you sell your business with the cash in, you could potentially a buyer might not want that level of cash before they buy it, but in theory you could sell it with the cash inside and pay capital gains tax rates at a maximum of 24% compared to 45% income tax rates. That's also true if you're just ceasing to trade and looking to either voluntarily liquidate. You could just leave the cash behind and extract it as a liquidation capital distribution and pay capital gains tax rates. The other thing you can think about is, if you are looking sort of to retire and you just have the company with the cash in, you could effectively use it as a quasi pension. So because dividend tax rates are, if you're in the basic rates, are very efficient compared to salaries and pension rates, you could effectively top up your pension by taking dividends each year until the money runs out in the company effectively. So you could just leave the company sitting there with a cash pot, invest it how you see fit, of course, but the income you take out of the company would be, if it's taxed at lower rates, could be an efficient way to top up pension payments that you receive in your retirement. So just some final little ones before we wrap up. Trivial benefits. So trivial benefits are effectively just small things that you can provide to employees, up to £50 a go. And even if you're a director of the business and it's your business, you can still benefit from these up to a maximum of £300 a year. But for your employees, they don't have that limit. Trivial benefits are things like buying a bunch of flowers for somebody at Christmas, for their birthday, or getting a bottle of wine at Christmas, this kind of thing. So, but as long as they're irregular, small amounts, so that they're not related to the employment duties as well. So if they're just one-offs, then that can qualify for a tax exemption. Similarly with suggestion box, I think people are not really aware of this one, but if you have a suggestion box and you pay people up to £50 for the enacting their suggestions, again, that's a tax-free amount you can pay someone, and that has to be open to all employees, but that can include you as directors. Again, it's limited to £300 a year, but you can take out, if you do enact your own suggestions, you can take out up to £300 tax-free. Probably more one for your employees rather than yourselves, but if you do have people who work for you for a long time, you can give long service awards, which again are tax-free on the 10, I think it's 10, 15, 20 years, etc. So you have to be a minimum of 10 years for long service awards to apply. Termination payments, whilst the rules around these have been tightened in recent years, termination payments, there is still ways to pay what we call ex gratia termination payments. If people are leaving your employment, up to £30,000 of that can be tax-free. You yourselves as owner managers would only ever be entitled to that if you had an employment contract. But if you have an employment contract, you need to watch out for national minimum wage legislation. And if you're only paying yourself £12,500 a year, you may fall foul of national minimum wage legislation. So for that reason, we rarely suggest having employment contracts for owner managed business.